Good night, good night. So I'm prepping for a move in my Roth IRA, and I wanted to share this with you guys in terms of like how I think through a couple things, what inspires me to do these moves. Uh, this video will be probably about 2 or 3 parts, and it will be done after I execute the trade. And so by the time you do see this, it's already happened, and hopefully it turns out okay. Now, listening to the Joseph Carson show today and talking with other people and just looking at the market, I will admit this move that I'm currently kind of putting out there in terms of like, oh, by the way, it is March 8th. So, she just turned 12. So, yeah, March 8th. Um, and so this move should have happened about a week or two ago, about 2 weeks ago, when the market was at an all time high, when my Roth IRA and my general investing account were just soaring to new levels without any money being put in. I had a feeling about this. I thought something was going to happen in terms of a market downturn. Mentally, I was like, "Oh, okay, this is going down. Like this might be the pre-bubble pop event where everybody's like, markets were at an all-time high and numbers and profit portfolio valuations were soaring, and everyone was making money and so on, and all that stuff. Um, I should have made this move probably about 2 weeks ago, which is why I'm gonna delay the actual. I'm gonna delay the release of this video. One thing that you should be always aware of is when a market is at an all-time high, um, it's possible, of course, that it could go down and it can crash pretty hard. I mean, that's kind of obvious, right? But what do you do to prepare for that? So I came up with a catchy name that goes with my YouTube name, and I'm gonna call it my BMP. My BMP, which is my bear market preparation strategy, or my bear market preparation move. And honestly, this is a way for me to semi rebalance my portfolio manually without actually going into rebalancing it using a robo advisor or using the robo advisor feature in M1 Finance. I'm going to sell off some of my shares, and I'm just going to be selective with it. So here in the growth portion of my portfolio, the growth portion of my Roth IRA, these are the stocks that were more than $100 in terms of profit. So this is the profit on those stocks, not the entire valuation or the entire valuation of the position. But these stocks are more than $100 in profit or in the green or in the money, and they are non-dividend producing stocks. Now, I was going through this, and Disney could have been one of them for me in my Roth IRA and my growth pie in my Roth. And I had to remember that dividend, they cut their dividend, and also I had to remember thinking about that in terms of um, buying into them. Like, when will their dividend come back? Will it ever come back? I believe it will. But will it ever come back? And what are you going to do in the meantime? Like, why are you buying things that are not producing a dividend? You need something that's going to produce a dividend and probably even have a strong dividend where it's actually going to give you some type of value. So I talk about AT&T all the time. AT&T is like one of my favorite stocks in terms of the dividend that it produces. It's about a 6% yield. You're looking at on per share, it probably produces about $2 is a realized dividend or the actual dividend payment that you get per share. And I always like it, and just kind of, for me, it's like the best bang for your buck. But of course, you don't want to dump everything into it. You know, you want to put it into like a portfolio that's a little bit more diversified, unless you feel really strongly about it. In this case, I said screw it. We're gonna go balls to the wall with AT&T here. We're gonna probably do a lot more. We're gonna do some in AT&T. So what you're looking at here, and I'm still working through this because you can see some of these numbers here, they don't match up here. So For instance, in total, I am 16 or $1,669.82 in the green amongst all these stocks, and I want to probably sell off about $1,500. Gives me a little cushion. In the case of like Tesla, I think actually I have to check this, but I don't want to fall too far below 2 shares. I will be buying more into Tesla later on, but right now I got to use the money I got and then put myself in a better position. So I don't want to sell out of Tesla right now. I want to keep the 2 shares because I have to play it as okay. Maybe I won't ever buy another share of Tesla, but then I'll lose out on the gains that Tesla may have. So if I never buy another share of Tesla because my broke ass can't put money towards it, then I'm gonna be pissed if it gets to $4,000 to $7,000, like per share. Um, People talk about that. Kathy Wood talks about this, even post split, looking at a $2,000 to $4,000 valuation of Tesla shares. Um, I believe it because it would be great for me, but at the same time, what if what if it doesn't happen? What does my portfolio do in the meantime? This is where I've always talked about in a bull market, I look freaking great, like I did something. Oh my god! But in a bear market, how do I look? So I want to make sure that I prepare myself for that. So what I'm looking at doing, and I'm just playing with the numbers here. These numbers were lower. The number really was about $1,300. So leaving a little bit in terms of in the green, so I won't be negative on those. But really shaving some of the profits off the top here, and that would probably be pretty nice. Now, if I look at the share price for AT&T currently at market close, or market close on Friday the 5th, it was $29.62. ARC-G, $85.14. Excuse me, and Intel Corporation, $60.74. Now, what you'll see here also is if I put this much in, this is how many shares I'll get. This is the expected dividend per quarter. Now, with M1 Finance, the magic number is $25 in cash in the account for it to trigger a auto invest for you, especially if you have the auto invest feature on. So the robo advisor will go ahead and buy underweight or buy shares of underweight companies. So for instance, your company is supposed to be at 5% valuation or 5% allocation within your portfolio. It will actually buy, but it's actually at 4%. That's 5% is the target. It's actually at 4.8%. It'll probably buy a piece of that. And there's a couple other restrictions or caveats to that, such as if it's less than $1, it won't go ahead and buy it because that doesn't make any sense to generate a trade for that. So, ARC-G, for instance, is something that doesn't produce. Oh, sorry. Let me not get off topic here. So this is pretty nice in terms of AT&T at $22.82 because other things are going to be producing a dividend within or producing a dividend within that portion or within that portfolio in general. I already have 30 shares of AT&T, so I should be getting about $15 from that. They've been consistent even through Corona, so that's really great. It's awesome. That portfolio is actually growing by itself or can grow by itself. Now, I want to get to a point where every quarter an auto invest happens. This is the best way that I can think of to maximize the money that's in my Roth IRA. Not just putting the $6,000 that I am restricted to put in there every year, but actually it doing things though where it can actually make money for the portfolio so that the portfolio can buy even more. Compound interest, compound investing. So these are things that you really want to focus on in terms of, okay, if you're doing a Roth IRA or something that has a long-term outlook, then you want to look at things that are actually paying what's it called? You want to look at things that are actually producing a dividend and actually working for you without you actually having to do anything. So every quarter I get a dividend payout. It's really nice. But right now it's probably only about like $12 or something like that, per quarter. I want to up that, and I also want to prepare or prep my my portfolio for any downturns or anything like that. so that I'm always making money no matter what. And again, that depends on these companies actually producing a dividend. Anyway, so let's go down to ARCG. The reason why it doesn't have an expected dividend per quarter is that ARCG, this is it pays a dividend annually, and it's not consistent. I think this ETF has only been around. It shows three payments. If you go on Seeking Alpha and go into dividend history or dividends and then dividend history, you'll see that it's only been around for about 3 years or so, and you know, 1 year paid like 20 cents, then a dollar, and then 30 cents or something like that. It's nothing serious, so I'm not gonna put it on there. The reason why I want ARCG is because that is a growth play for me, and I want to get at least some position in there, and then start funding that more over time. So I can just say, hey, listen, screw it. Why even do ARCG? I want a position in there. Intel, it's another one where I want a position in that. It's in the portfolio, but since I haven't put money in that section of the portfolio, it has not been getting any love whatsoever. So I want to at least get 2 shares or so of Intel, and that's only going to give me 81 cents. Like if I look at what its dividend, let's see here, it's producing 33 cents per share in dividend, or that was the last dividend that it produced, or yeah, that's the last dividends that it's produced for 2020. All 2020, every quarter, it paid out 33 cents per share. I'm going off memory here. I probably should have had Seeking Alpha up, but don't judge me. I'm trying to get better. Anyways, but yeah. So with that being said, with Intel, it's only done 33 cents, or it's done 33 cents. With that, I want to get a position in Intel. Some money's better than no money, and also I expect to actually put more money into this over time. I need to put quite a bit of money into it to rebalance my Roth IRA about 3,500. That's what I really want to get to. But as you can see here, and I try to be transparent with some of the stuff that I'm doing here, my position and where I'm at. I show you, hey, listen, these are my debts. These are the debts that I have to go and pay off. I have to get rid of these. Ran up this credit card the other day just because I wanted to get my barn torn down. So I went ahead and got that done. The BB&T card, that's my general card, and I had some other stuff I wanted to get done around the house as well, and a couple of things coming up, and also I'm probably gonna have a medical bill pretty soon because of actually what happened to me. But and then M1 Finance, me taking out money so I can actually make the YOLO move. As you can see, that YOLO move ROI is 47.63%. I actually made some changes in how I did the calculation, some of the numbers, because I've actually traded out of some of these. So for instance, I transferred $1,500 or converted $1,500 worth of XLM to Ethereum. So doing things like that to further diversify and take money off the table. I'm doing the same thing here. So this is why I said I should have done this weeks ago. Weeks ago when the crypto market was a little bit higher, I should have been doing this a little bit more. I should have been paying attention to it more. I should have been thinking about this more, thinking in this mindset. And this is why mindset is important, because if you don't do these things when opportunity presents itself, you may actually lose out. So, going on. If I do $1,300, which is kind of like the point that I really want to do, I may do a little bit more. I'm not sure. 1,300. My numbers are out of whack here, so I would have to sell all of this to get 1669 or about that, because how much it is, or how much everything is worth, or how much I'm in the green by the time the market opens and the trade settles may change. So I may actually have more money to play with, or I may have less. But we're going to work with about $1,600, and then I would probably sell about $1,500 worth of shares across these companies here. And then my numbers are off here, so I have to probably do 100, because that's semi-bothering me. 113, there we go, cool. So that point, it's okay, 1.65 shares of Intel. Not that big a deal, big guy. Might as well just say dick in the dirt. I don't know why I usually like to use that term. I'm perverted and risky. It is what it is. Anyways, so if I put $1,500 in AT&T, that'll get me 50 shares. Expected dividend per quarter is $26.33. You already know that part. So let's go over to this. What that would pay out, or how that payout would look over a course of a year. $105.33 pennies. But that's $105 that I didn't have to do anything for. I just had to invest and keep the money in there. Now, what's the power of all this? These are small amounts, but that $26 right there, if AT&T keeps its dividend over a long period of time, and probably even increases it, which would be great. But if AT&T keeps putting out a dividend, that $26 will automatically trigger every quarter an auto reinvest into the portfolio, along with all the other dividends that I'm getting on a regular basis or on a quarterly basis. I think last quarter I made probably, I think it's like 20 something dollars or so, or maybe it's probably more than that. Actually, I can tell you. Let me open up the app here. M1 Finance app. I use the app more than anything, to be honest. When I'm sitting in bed, just laying down, and want to have something to look at because there's nothing else going on. Let's see here. Go over. So all time, I've made $104.03 in dividends. Now, if I look at, let's just do a quarter. So last quarter, $38.33. So now $38.33 plus the $26.33 that I'm trying to go after here. If I just buy all AT&T, I zero these out, right? I don't get those. I'm looking at $26.33 along with the $38. I mean, that's a good amount of money to put towards, making purchases in that portfolio every quarter. Now, what's the valuation if this Roth IRA gets even higher over the years? And this is what we're looking at, is just the compound, the future value of everything. We're looking at $38 plus $26. That's $50. It's $4. So that's $64 right there. Yeah. Check me if I'm wrong. That's about like $64 is what I'm getting. So $64 and some change will be reinvested into the portfolio every quarter. Don't have to do anything. If I don't put any money into it, which will suck, but if I don't put any money into it and we're looking 25 years later, I mean, let's look at that. So 100 times 25. How did I screw that up? Times. So we're looking at $2,633.36. Now, again, this money will be reinvested every quarter. It will buy more shares of the companies that I like in that portfolio. That portfolio will continue to pay out even more dividends because I've actually reinvested that money and not taken anything out. No penalties or anything else like that. So by the time we're looking into retirement, this could be an even larger number, especially alongside that I'm putting more money into it and feeding the portfolio even more. So this is the importance of compound interest, or it's called compounding in terms of your investing, or reinvesting your dividends. And that's the proper term, but reinvesting your dividends. By reinvesting your dividends and then also diversifying to the point where if Tesla falls, it doesn't hurt you too much. Square falls, it doesn't hurt you too much. Square could fall today and be really bad. Also, if I go back to the growth section of my portfolio and look at Square, a couple weeks ago, if I, in this quarter alone, Square, the current valuation of my position with Square is $1,099.26 at the height of this quarter. This actually was, and the height was February 19th for this. So it's been falling since then. But since February 19th, the height was $1,404.65. So I've lost quite a bit of money in that, like $300. Yeah, about $300. Maybe 100. So yeah, it'd be like $300, a little bit over $300, right? But I've lost that $300 that I could have taken and bought even more AT&T. $300 in AT&T would have been 10 shares. Those 10 shares multiplied by 52 cents, which is the last dividend that they actually came out with. those 10 shares would have produced $5 worth of or would have produced $5 worth of dividends. So by not actually watching this and pruning these things when necessary, I've missed out on an opportunity. And this is what I talk about all the time: preparing yourself for an opportunity. All right, so with that being said, there's still more work that I have to do. I will be watching the markets. I'll probably be making this move again. It's morning, and I've had a chance to think about my trade. Now I've changed my mind, and I'm gonna do things a bit differently as we trade. Ooh, we forget about the things we were gonna do. Okay. Y'all can see why I'm not a singer. But I had a chance to think last night, and actually really this morning. Went on my morning walk, did my 2 miles, did a little bit of band workouts to work out my shoulder, or chest and shoulder, a little bit of rehab. I'm going to make this portion of the video quick because I'm actually working. I thought about it, and I said, hey, okay, the market's up. Oh my God, this is great. So a little bit more money in the pot, if you will. In some cases, I think Tesla's up like to 3 something in terms of profit, and Square is up like, or is actually at the same amount. So I actually made some changes. I'm not gonna focus on any other stocks. Just gonna focus on AT&T. Now with AT&T, I'm just gonna do $900. I'm only gonna sell off a portion of my profits in each one of these, just because I do still believe in these companies and what they're going to do. MongoDB, I believe, is going to be coming out with their earnings report pretty soon. Elasticsearch is a smaller company. And I don't want to lose any position in Cloudera as well, and AMD. I don't want to lose too much. But I do want to take some money off the table here and put it into a more long-term, stable, dividend-based investment. So what I'll be doing is trading out of Tesla, 250, 500 out of Square, 50 out of AMD, 50 out of Cloudera, 25 out of Elasticsearch, 25 out of MDB, and then I'll take that $900 and I'll put it into AT&T. That'll give me an expected dividend for the quarter of $15.80 and yearly dividend payout of probably estimated at $63.20. Sorry, my voice is crackly. I haven't talked that much this morning. I did my morning meeting and everything like that. Now I got to get back to coding. But I wanted to actually make this video. Also, one thing that's pretty nice, you'll see the difference in the numbers, is that now instead of being up 47% on my YOLO trade that was done on January 17th, or since January 17th, I should say, I've been tracking a little bit of what I've been doing in each one of these since that date. I have, since then, I'm up 50.61%, and that's pretty good. I mean, I did want to make a video about this, but I'll make it a subtopic of this video. But do I want to trade out of this? I mean, what are my goals? What do I want to do? Is it worth me, canceling out most, if not all, my debt right now, and then continuing, and then, start building up a position again? Or should I get in while it's low? I'm going to pick get in while it's low, gain some volume to a certain extent, and then keep building that position over time. I will be, trying to get some other work so that I can actually pay off my debts without actually having to sell any of these positions anytime soon. You never know what could happen. We always have to be cautious in the market. Things can happen. But it would be nice if, I can get another bit of stimulus check or something like that. I want to say I'm probably going to have to pay that stuff back, which is okay. I'll take the money for now and then just pay it back over time or something like that to the IRS. But we'll see. They usually want their money pretty quick. But for the most part, I think this is going to be a good move. If I didn't think it was going to be a good move, I wouldn't do it. But $900 in AT&T, getting those 30 shares, and those 30 shares continuing to pay a dividend for me in the long term, I think it's just going to be a great move in the long term, and I think it's going to be great. And I thought to myself, if you can't make these moves, or if these moves are hard when they're smaller numbers, like what I'm dealing with, $900. I mean, it's not that big a deal. I mean, it's what, like two PlayStations, to a PlayStation and an Xbox. Um, that's not even like that's like an i7 computer. I think my Surface was. I think I paid close to $1,000 for my Surface. Like, I paid some good money for that. I think I paid like $700 or so. But it's not a lot of money in the quote unquote grand scheme of things, especially with inflation. So I feel good about making this decision. And again, this is always about mindset. This is never about the trades that you're doing. Those trades will always be there. The narrative will always be different, and it'll always be something else. This is all about your mindset when you're actually doing things like this and saying, okay, if I do this trade here, what does this mean? What are the long-term ramifications? Okay, maybe I should not. Oh, great, you got another email. So maybe I should not be doing this right now. So I feel good about this. This is a bit of an exercise, and I've already made the trade, or actually put in for these trades to happen. And with the way it works is I can actually buy into AT&T today as opposed to waiting for it to settle with M1 Finance, which is pretty nice. So with that being said, as always, thanks for listening. Really do appreciate you. And yeah, I hope this helps somebody. As always, if you're not taking what I say with a grain of salt, then you're low on sodium. All right?